Britain loves fairness. We pride ourselves on giving everyone a fair shot, a fair wage, a fair deal. But there's one glaring exception: intergenerational wealth. Because while we argue over tax bans and benefits, one group quietly sits on the spoils of the past 40 years, largely untaxed, politically sacred, and economically untouchable. Welcome to the Polite Contrarian. This episode isn't about blaming older people. It's about unlocking stagnant wealth to fix a system that's increasingly broken for everyone under 50. Before we get to private wealth, though, let's talk about the bit the government actually controls, because there's a lot of untapped potential right under its nose. We're talking about public sector efficiency, an invisible dividend. And it's not just productivity inside departments. The government also drives massive inefficiencies through overly complex and expensive regulation, particularly in housing, infrastructure, and energy. As we explored in detail in Series 1, Britain's housing crisis, Britain has perfected the art of requiring private investment to run an obstacle course of planning delays, environmental reviews, and fragmented oversight, often only to get blocked anyway. Billions are wasted not on what we build, but on how long it takes to get permission to build it. This is the regulatory equivalent of burning money in a filing cabinet. As for the public sector itself, UK public sector productivity has been broadly flat since the early 2000s, according to the Office for National Statistics. While technology transformed private industry, public services remained largely immune to serious reform. Leave aside the recent AI boom, the introduction of email, cheap computers, mobile phones, broadband internet has all had precisely zero impact on the output of the public sector. It's almost baffling how they manage this. A huge chunk of state spending isn't underused, it's misused. We're not saying sack everyone or slash services, but making government itself more efficient, whether through digitization, better procurement, or smarter management, could unlock real economic growth without needing to raise taxes or nationalize anything. What this means in reality is improving people's standards of living, their lives, without increasing tax and spending. In fact, if public sector productivity had simply kept pace with the private sector since 2000, we could be delivering the same or even better services today while spending around 23% less overall. That's a saving of over £280 billion per year, enough to eliminate the structural deficit, cover the UK's debt interest bill, with change to spare. In other words, we could have maintained or enhanced service levels without any borrowing at all, fundamentally reshaping the fiscal landscape. And it would restore public trust. Right now, people don't just resent paying tax, they resent seeing it wasted. One way this can be grappled with is via the public sector's key incentives. Many public sector workers still benefit from defined benefit pension schemes, promising fixed payouts based on final salary and years of service. These have virtually vanished from the private sector because they're too expensive and too risky. Yet the taxpayer still underwrites them for millions of public workers. These pensions aren't just relics, they're open tabs, written decades ago, that will be paying off well into the 2040s. Most public sector schemes are unfunded, meaning they're paid straight out of current tax revenues. While many are closed to new joiners, the cash cost of meeting pension promises is still expected to peak in the 2030s and 2040s as the largest cohorts retire. Reforming the system for new staff might help future budgets, but does little for the fiscal squeeze we're already in. Let's be honest. The traditional justification for gold-plated public sector pensions was that pay in those jobs lagged behind the private sector. That excuse has expired. As of December 2025, median weekly earnings for full-time public sector workers are roughly 770 compared to 720s in the private sector. When you include employer pension contributions, which average 18 to 20% in the public versus just 6% in the private sector, the total compensation gap becomes a chasm, roughly 920 per week in the public sector versus 760 in the private. Factor in greater job security and near zero risk of redundancy, and you begin to wonder who's subsidizing whom. In effect, most workers are funding risk-free pensions for others that they themselves are not legally allowed to have. This isn't about envy, it's about basic arithmetic. If we're talking about unlocking wealth and promoting fairness, reforming legacy public sector benefits has to be part of the conversation. Not because public servants don't deserve security, but because it needs to be sustainable, fairly balanced against what we ask of the private sector that is paying for it, and economically productive. Private sector workers, taxpayers, have every right at this point to demand more in the way of public services and living standards for their money. Now that we've dealt with the inefficiencies the government actually controls, the state's own productivity, the pensions it underwrites, the regulations it imposes. Let's turn to the wealth it fears to touch. Let's start with the raw numbers. And before anyone suggests we wait for it all to sort itself out naturally, the much-discussed silver tsunami of inherited wealth, let's look at the figures. The vast housing wealth held by the over 65s doesn't flow straight down to struggling young families. It flows gently down a notch first, typically to their already asset-rich 60-something children. With only about 300,000 deaths per year in the UK and an average inheritance age of 61, the idea of housing wealth naturally trickling down is not a plan. It's a myth with a walking frame. Even with more deaths, the structure of ownership, joint tenancies, trusts, spousal transfers, means most property stays locked up far longer than the economy can afford. Over 65s now hold more than 1/3 of the UK's $15 trillion total wealth, despite being just 18% of the population. Nearly 80% of housing wealth is held by those over 50. Specifically, those over 60 now sit on a record $2.89 trillion of net housing equity. Pension assets are overwhelmingly skewed to older, wealthier households, with the top 10% holding median wealth of 1.2 million plus. At the same time, median wages have been flat for 15 years. First-time buyer age has risen from 29 in 2000 to nearly 35 today. Effective marginal tax rates for younger, lower-income earners are often higher than for retirees drawing previously untaxed pension income. This isn't just inequality. It's fiscal sclerosis, a society where wealth exists but refuses to move. So how did we get here? We didn't plan it, but the system evolved to reward. Asset ownership over productivity, past contributions over present effort, hoarding over investment. The post-1980s boom in home ownership, coupled with mass privatization and the rise of retail share ownership in the 1980s and 90s, created a vast middle-class wealth engine, but the tax system never adjusted. There's no capital gains tax on primary residences. Inheritance tax is riddled with loopholes. It's less a system of contribution and more a playground for accountants and lawyers. The original idea, to prevent inherited wealth from accumulating endlessly, has been hollowed out by decades of tweaks, exceptions, and quiet avoidance. Council tax banding was frozen in 1991, so the levels are too compressed. Pensions are given massive upfront tax relief, then lightly taxed on exit. Gold-plated public sector pensions are underwritten by the taxpayer, which might have been fair when covering 5 or 6 years of life after retirement, but look less so now when people are retiring at 57 and living to 93. But here's the twist. Those very reforms, privatization, mass home ownership, widespread shareholding, that once expanded opportunity, now entrench inequality. The Thatcher-era dream of a property-owning democracy delivered an equity boom. But unless we find ways to unlock that capital today, it risks becoming a gilded cage. It's time to revisit those policies with fresh eyes. How can we make them work for the economy of the 2020s, not the politics of the 1980s? Why hasn't this been fixed already? It's simple. Older, asset-rich voters turn out. Young, asset-poor ones don't. And politicians, they're terrified of 2 things. 1, triggering a housing crash. 2, being accused of a war on pensioners. So instead, they fudge by freezing income tax thresholds, a form of stealth tax. Offering schemes like Help to Buy, fueling demand, not supply. Ducking proper IHT reform, again. We get micro-adjustments, not courage. Unlocking wealth matters. This isn't about resentment. It's about rebalancing risk and opportunity. Because if we don't act, younger generations will continue renting into middle age. Capital will flow into passive assets, not productive investment. Public services will stagnate as revenue from income dries up, while vast housing wealth sits inert. It's not sustainable, economically, politically, or morally. In response to this, voices like Gary Stevenson and Zach Polanski have called for a simple annual wealth tax, usually 1 to 2% on assets over 10 million. While their diagnosis of asset hoarding is correct, their cure is a blunt instrument that would likely backfire. Wealth isn't just cash in a vault, it's often tied up in private businesses. Forcing a business owner to sell shares annually to pay a tax bill, for example, destabilizes the SMEs that drive UK employment. Then there is the valuation nightmare. Assessing the value of every private company, classic car, and piece of art in the UK every year would create an administrative bureaucracy whose costs could swallow the tax yield. Dennis Healy famously identified this as the main obstacle to introducing a wealth tax, and he was hardly shy of imposing punitive rates on what he considered had not been earned. Polanski argues people won't leave, but mobile capital certainly will. In a globalized 2026 economy, liquid assets can move to Singapore or Dubai at the click of a button, leaving the UK with a narrower tax base. Finally, critics argue it punishes those who have already paid up to 45% income tax to build their savings, essentially taxing the same pound twice, which discourages the very long-term investment the UK needs. We don't need to punish the possession of wealth. We need to use taxation to disincentivize its stagnation. So, what can be done without causing revolt? Let's talk solutions. This isn't about forced redistribution. It's about unlocking frozen capital. First, reform council tax and introduce land value tax. Council tax is regressive, outdated, and geographically unfair. The compressed and outdated bandings alone are unjust. Replace it with a land value tax, levied on the location, not the structure. Low-income homeowners can defer payments until sale or death. No evictions, no panic. But finally, we tax wealth where it lives. Second, replace inheritance tax with a lifetime receipts tax. Scrap the IHT charade. IHT only needs to be nominal to reflect the administrative security of ensuring bequests pass on to where the testator desires. It can fund the probate system and a contribution to the court system, but little else is justifiable. Replace it with a progressive lifetime receipts tax, tracking how much each person receives, not how much someone gives. Exempt the first £125,000. Tax increasing percentages thereafter. Apply this to all gifts above the threshold, including property and trusts. Fairer, simpler, harder to dodge. Next, encourage equity release for national investment. Introduce a national infrastructure equity bond scheme. Homeowners over 65 can invest unlocked housing equity in a secure, inflation-linked bond that funds housing, energy, and transport. They earn income. The state earns capital. You build national resilience without stealth taxes or haircuts. Building on this, reform stamp duty to encourage downsizing and mobility. There are many older parents, empty nesters who might well like to move house to something cozier now that their family has moved out. However, the punishing incidence of stamp duty is a huge block on this. This is even more so if, for example, they have hung on to a buy-to-let or holiday home, triggering the surcharge. Imagine such a couple in their early 60s living in the family home, which after a couple of decades is now worth £1.2 million. They like the idea of selling and moving to a smaller house that costs, say, £950,000. Unlocking £250,000 they can spend perhaps taking early retirement before drawing on pensions. However, the stamp duty on that purchase would be nearly £90,000, wiping out a huge chunk of the equity being released. Why bother? We end up with large family homes being fully occupied for 2 weeks a year when the grandchildren visit, while younger families cram into the 2-bed flats that are the only things being built at all these days. Meanwhile, the £250,000 that could have been injected into the economy still sits there. Fifthly, align pension fund incentives with UK growth. Pension funds sit on trillions. We don't need to confiscate it or even direct it, but we can shift the incentives. However, we must learn from the Rachel Reeves British ISA debacle. Reeves's attempts to mandate or nudge investment into UK assets were met with fierce criticism from the industry, who argued that forcing capital into the UK stock market would actually lower returns for savers. Critics pointed out that if UK assets were attractive, funds would already be buying them. Mandating it is just a stick that creates market distortion. Instead of a clumsy mandate, we should reward investment in domestic housing and infrastructure, penalise passive capital outflow, offer UK growth wrappers with enhanced reliefs or guarantees. If we can do it for so-called ESG investing, we can do it for things that are of tangible benefit to the economy as well. Make investing in Britain not just a patriotic slogan, but a pension strategy. None of this works without a change in narrative. Right now, the idea that wealth taxes equals theft is baked in, but taxing labour till the pips squeak while sparing passive gains, that's the real theft. We need to reframe fairness. Fair doesn't mean everyone gets the same. It means no one gets to hoard privilege while others drown in rent and tax. This isn't about asset seizures, forced liquidations, or intergenerational warfare. It's about recognizing that Britain's biggest economic problem isn't scarcity, it's stasis. Money exists, capital exists, talent exists. What's missing? A political and fiscal model that knows how to put them to work. If we free the wealth, we can fix the future. We don't need to punish older generations, but we do need them, and their representatives, to accept that sitting on wealth while taxing work is a broken model. Unlocking wealth isn't theft, it's economic CPR. Because if Britain is richer than it acts, then now is the time to act like it. If you're under 40 and still watching, congratulations, you've made it to the rage bonus round. If you're over 65 and you didn't rage quit halfway, we salute your intellect and your internet speed. We are politely contrarian. Subscribe, forward, and whisper the phrase land value tax into your next dinner party. That's the revolution we can all enjoy.